Well, we're going to get started here. I'm going to do the introduction of both Fuel, which is my company. My name is John Perillo. I am the founder of Fuel. And Fuel is a cap intro platform. We think it's the state of the art, one of the best cap intro platforms that is in the market today. It allows allocators and managers to connect, quite simply. We have a lot of different options in terms of how that happens. The primary one, I think, that really sets us apart is the year-long subscription that we have that really keeps people there for the long term. Connections take time. To think that connections are going to happen just over a week or two is not the way that it tends to work. Today, as part of our series, we are talking with Dennis DeBusschere from 22V Research. I'm going to put his biography on the screen for you here while I talk about 22V, because 22V is really a firm that I have gotten to know over the past 6 months or so. They've been nice enough to let me have access to their research. And I'm going to tell you, this is not a paid advertisement. This research is top notch. I have been an allocator, I've been a manager, and I've done this for a long time. This is great research. They have people doing commodities. They have a China specialist. They have a policy specialist. They have someone that deals with rates. They even have a technical analyst. The work that these guys do is really phenomenal. It's in-depth, but there's also summaries. It's very accessible. It's very easy to understand, and I love it. I really think this is top-notch research. So hopefully you're reading Dennis's bio on the screen here. I'm going to bring Dennis in now, and Dennis and I are going to talk today about a few macroeconomic topics. GDP being the first one. Everybody probably saw the print of GDP from just last week. Very, very strong. Dennis is going to help us unpack that and understand the ramifications of that on global markets. We're going to talk about interest rates because they're pretty important. Everything that the Fed is doing these days is impacting markets, impacting investors. And then we're gonna close out with a discussion about geopolitical events. And if you have questions, I encourage you to ask them. We will probably get to them towards the end, but if it flows with the conversation, I'll ask Dennis live here. And yeah, Dennis, thank you so much for joining. Welcome.
Yeah, great to be here, Jan. Thank you so much for letting me come on.
Absolutely. So, Dennis, like I mentioned just a moment ago, I would like your help in interpreting this very, very strong GDP print from last week. It's pretty fresh, it's pretty new, but are there any kind of just under the surface, or what should we really know about this GDP print?
So great place to start. So just a quick refresher for everybody. So GDP in 3Q came in at 4.9%. The estimate going in was, I think, 4.7, so a little bit better than expected. And a clear acceleration relative to the what we saw in 2Q and the first half of the year. And just to give everybody a little bit of context, we survey a lot of investors. And to start the year, the buy side had 80% odds of a recession happening this year. So our buy side investors had 80% odds of a recession happening this year. By the way, 20% of those had 90% or above odds of that. So pretty extreme kind of positioning. The economy was okay in the first half of the year, roughly running at a 2% pace, which is right in line with trend. Obviously, we had the banking crisis. People got very concerned about GDP again. And lo and behold, the recession never showed up, despite senior loan officer survey being negative, despite a lot of survey-based data pointing to some deterioration in the economy. Our main call has been that near-term recession risk is low. And we define near-term recession risk as within the next 8 to 12 months. And longer-term recession risk is elevated only because the Fed does need to slow down demand growth. And the Fed needs to do that to get inflation under control. All right, so I think where a lot of investors in the buy side were so worried about a recession was pulling forward those longer term drivers of recession to a near term problem. So because housing significantly was a significant drag on GDP late last year, people thought that that would flow through to other areas of the economy in the first half. Banking crisis already mentioned. Then what happened in 3Q is we started to see an important acceleration in economic data. So we went from roughly a 2 to 2.5% pace, which is actually pretty strong historically. I'll come back to why, because it's an important conversation. And we saw this acceleration, which finalized in a 4.9% GDP print. Nobody had that on their bingo card. All right. So just to let everybody know, there was people that were arguing against a recession like us, but we certainly didn't think there was going to be a mini boom in the third quarter. Now, the main driver of the mini boom really rests on consumer spending. So real personal consumption expenditures in 3Q ran at about a 4% pace. All right, so that's on a real basis. That is boom territory. Just to give you context, in the pre-COVID period, real PCE or personal consumption expenditure growth was basically 1.25. That was your trend line. So we are significantly above that. At the same time, the housing drag that I mentioned, and when I say housing drag, I'm talking about residential investment as a percentage of GDP, which crashed last 3Q and 4Q, was not going down anymore. So mathematically, it was a positive contributor to GDP, as was the production side of the economy, because the ISMs, or the ISMs, if you want to use the cool way to say it, I guess, were not going down anymore. So you had these two mathematical positive impulses at the same time that consumer spending was significantly stronger than expected and accelerated. Now, an obvious comeback to this is like, what the heck is going on? Interest rates have gone up a lot. Mortgage rates have gone up a lot. Obviously, credit card rates have gone up a lot. Why is the consumer so strong in the face of the sharp interest increases we've seen in interest rates? And this is where I think we've done, again, we didn't call for this boom in 3Q, but I think we've done a really good job of laying out what are the underlying drivers of consumer spending and why it's maintaining and likely to maintain. First and foremost, wealth effects are completely or underestimated by Wall Street. And when I say wealth effects, I'm talking not just your stock market portfolio. I'm talking about broad wealth effects, which includes income, house prices, so your home equity, et cetera. So relative to January 2020 through today, the average household or the median household has had a plus 40 trillion increase in wealth, right? So in aggregate, I say, obviously not that median household. So in aggregate, we've had a 40 trillion increase in net worth, which is staggering relative to history. When you have very large increases in net worth, which we've seen, and you're also at full employment, which we are, you tend to see lower savings rates. So the savings rate has come down significantly. That lower savings rate is a large part of the reason why consumer spending has been so strong. And now here's what happened very specifically in 3Q, which is part of the reason why you shouldn't expect the boom to continue, is that we had a positive real income shock. What you probably notice is headline inflation has come down from the peak. It's still high, too high for the Fed, and we can come back to that when we talk about rates. But headline inflation has come down on a year-on-year basis, roughly to the mid-3 handles right now. But measures of wage growth are still running at 5% plus. If you take like the Atlanta Fed's wage growth measure right now, it's running about 5.1%. So you had a positive real income shock in 3Q at the same time that savings rates stayed at very low levels. And the net result is very strong spending at the consumer level. What a lot of people are missing when they think about consumer spending is a lot of the spending is happening in services, so travel, leisure, restaurants, anything that doesn't require financing. So you are seeing softness in home purchases. That's been very well advertised. You're starting to see it in auto, but anything that requires large financing is seeing a slowdown in spending. But people have just shifted their spending to areas in which it doesn't require financing, and they can do that because their net worth is up significantly. They have positive real income shock, and the net result of that is, people just spending a lot more relative to what we've seen historically. That's going to change going forward. That's our call. It's still going to be positive, and the reason that's going to change is you're probably going to see some deceleration in wage growth going forward in a non-recessionary way. I mean, it could end up it could have a bad outcome. I can get into that if you want, but I would say wages are pretty highly likely to decelerate over the next couple of quarters. Quits rates have come down. A lot of leading indicators of wage growth have come down. Actual goods and services inflation have come down. So wages should catch down to the decline you've seen in goods and services inflation, which should cool spending just a little bit.
So when you're looking under these GDP numbers, is that where you're getting all of this data, or is this something that you've had to kind of tease out from other sources of data? I mean, how much detail can you get just from that one print versus how much did you see coming into this print based on some of that other data in terms of, non inflation or non interest rate sensitive sectors or silos doing better than the interest rate sensitive ones?
Yeah, so most of the information we got is outside of the GDP calculation. So retail sales, I mean, all this stuff sums up in some way, shape, or form to GDP. But you take retail sales would be the main area where we've seen strength. High frequency labor market data has been very firm. Wages have been firm. The savings rate, which comes out as part of the personal income and personal consumption expenditure reports, all this stuff ends up in GDP at the end of the day. But it was obvious throughout the quarter, given the data that was coming in, particularly through the consumer side of the economy, that demand growth was going to be very strong. You just don't know because the GDP calculation can be funky sometimes. You didn't know if it was going to be 4, 5, or 5%, but we knew it was going to be very, very strong.
So you brought up a little bit about how many economists, and I think there's some stats out there about Wall Street Journal doing some surveys of economists back in late 2022, and I think I think you said 80%, but I think I've even seen surveys that had literally 100% of economists were saying, and obviously that wasn't you guys, but there were, from the survey, 100% of the survey respondents expected a recession in the next 12 months. Within the next 12 months, there would be a recession. And obviously that wasn't correct. I mean, especially given that most recent GDP print that we just saw. But what, and you touched on this a little bit, but what really was in that data that was so convincing that there was going to be a recession versus what happened in the meantime? I mean, was any of that policy from the government? I mean, I've heard a lot about the Build Back Better. How did some of these things impact, that GDP?
Well, so it's a great question. I'm going to give you the short answer because this is another webinar discussion. But but I would say the main thing to focus on is that anybody that did regression analysis missed the non-recession call. And regression analysis failed, particularly here. When I say regression analysis, when the PMIs typically go below 50 for an extended period of time, recession risk is significantly higher. When the yield curve is deeply inverted, your recession risk goes up. Survey-based data was very negative, like consumer expectations data, just consumer confidence data is still in the 15th to 20th percentile. It's been horrible. So when you take a combination of the unknown of a Fed tightening program, deeply inverted yield curve, the PMI rolling over, consumer confidence data coming down significantly, people and the Fed's own workhorse model, which is very yield curve dependent, pointing to recession, economists just said, all right, we're probably going into a recession. Okay. Now, where I think one of the things we did that I think was pretty clever is we decided to look at the economy on a bottom-up basis. Instead of using regression analysis, and the reason we did that is because coming out of COVID, you have a lot of bullwhippy effects related to the staggered reopening and the fiscal stimulus. So when you think about it in these terms, for the first year and a half after COVID, when people were essentially not fully locked down, but more or less locked down, there was a significant fiscal impulse that led to goods purchases going up aggressively. So the service economy was shut down and everybody was spending on goods. Okay. Then the economy reopens roughly March of, I guess, 21 now, 22. Yeah. So 21, the impacts were probably more last year, 2022. But when you had that shift from goods purchases to services as the economy reopened, Also, going into that shift, there were supply shutdowns or potential supply shutdowns in China. So supply chains were compromised, and a lot of companies were ordering or over-ordering to make sure they had goods for the next Christmas season. Well, lo and behold, the economy reopens and already shifted their spending pattern from goods to services. This is nothing we've ever seen before. You typically have fairly stable, synchronized spending throughout the economy, but we had a very desynchronized spending pattern. So if you're looking at the PMI on its own, what that's capturing is a surge in spending, compromised supply chains, got you to like a 70 reading. And then as you over inventoried and everybody at the same time shifted their spending to services, the PMIs collapsed. So should we say that the PMIs are indicative of an oncoming recession? Or is there something unique to this cycle that might be a little bit different given the post-COVID staggered reopening environment? And you could take that across sectors. There's kind of been this rolling basically this rolling recessionary. So the service sector was in a recession for a while, as the goods sector was not. Then it flipped. You're seeing it in autos a little bit now. And so I think that was the main thing that people miss. And then the other part of the yield curve, which I get a lot of questions on, it was deeply negative because inflation was so high. Meaning, and people know that the Fed had to raise the short rate aggressively. But inflation was very high because of a supply and demand boom. Well, a demand boom meaning a supply constraint. It wasn't labor market driven. Right. And so that's an important distinction. Why the yield curve is a little bit more misleading this time around, because if you normalize supply, then your recession odds go down, and the rest is history. We could still end up in a recession. We could still over tighten. All those things can still happen, but you had to look at things bottom up, which is how we came to wealth effects, savings rates, underlying drivers of demand.
I remember having several discussions in 2022, and not nearly as many as you had, obviously, but about the effects of COVID and coming out of COVID, and how that's kind of skewing a lot of the data prints that you're getting from the year over year type prints, because you're just in this really weird time, and nobody, not nobody, but I think most people had no idea how to interpret that data. And so it was really, really difficult. And then you couple that with the inverted yield curve that everybody seems to think always leads to a recession. It was, it led to some really negative interpretations of what the economy was going to do. But I think one of the things that really we can talk about now is the yield curve, because I think that was part of the driver. With, like, as you said, that short end really rising fast to tackle inflation, but the long end was not with it. It stayed very low, and you had this massive inversion. I don't know if it, historically, where that ranks in terms of the length of time and the degree of inversion that we had. But we've started to see some normalization now. Just in the, if you look at the last month, sure, you're really getting that long end of the curve coming up versus the short end, which is staying exactly where it was the month before. Within a couple of basis points. So, let's talk about rates now, Dennis. I mean, what are you seeing in interest rates in terms of what to expect moving forward, into what to expect, how that's going to impact the economy in some more sensitive sectors, like you said?
Yeah, so this is an important discussion, and it's a good segue. The strong economy now has been met with higher interest rates, particularly on the long end, which has obviously compromised risk assets, the markets. All right, rates being the main driver, and so first and foremost, the flattening or steepening off of the curve that we've seen over the last 2 months, which is historic 99th percentile on any measure, is mostly driven by the financial community catching up to on the ground economic reality, which is a long-winded way of saying near-term recession risk is low, and the Fed has and the increase in interest rates we have seen are not going to lead to significant downside economic and, by extension, inflation risk. Right? So if the interest rate of roughly 5% that we have now is not enough to cause a recession, or with that 5% interest rate, your recession risk is actually lower than we thought, then by definition, the yield curve should steepen. And that's what we've seen, right? So the reality of non-recession and the ability to live with, for now at least, 5% rates is why you've seen that steepening. A lot of credit is given to supply issues, like you've probably heard about the massive increase in supply, and QT, obviously related. Those are issues, but not necessarily for the reasons you might think. The cycle does dominate. And I think it's important because it goes back to the GDP discussion. We do have a fiscal impulse, a consistent fiscal impulse, and the private sector is strong. So if you have the combination of a strong private sector, which is growing above trend, right? So if we think the economy can only grow at 2%, given the labor and productivity headwinds, if you're growing well above 2%, you're going to have, all things equal, upside risk to inflation. All right. If you have upside risk to inflation because you have a private sector that's very strong and a deficit that's, slated to increase, which means stronger economic growth or an impulse to economic growth, then you have much more inflation risk and term premiums. Essentially, the inflation risk embedded in 10-year yields increases, which is exactly what we've seen. So the term premium, which was estimated to be negative, meaning you made more money by rolling over short duration rates than you did by owning 10-year bonds, at least estimated. We can't really see this perfectly, but now that's adjusted. So your inflation risk embedded in 10-year yields has gone up significantly, and a lot of that has to do with the reasons I just stated. It also means that your risk of going back to zero on the Fed funds rate is reduced significantly. Right? We're moving away from that era of disinflation, and that's becoming obvious. Okay. So term premium going up is your reflection of the market having trouble digesting supply based on expectations of consistent above demand GDP growth and associated inflation risk. So from here, it's really important that the economy slows. Really important. Otherwise, you run the risk of 10-year yields just going up to a point that really just choke off economic growth, and we have a harder landing. And the only way you're going to get 10-year yields to calm down is one of two ways. You either have fiscal orthodoxy, where you want to say austerity, like we reduce the deficit, which is not going to happen, by the way, within the next 2 years going into the election, so it's just not going to happen. Or you have the private sector, household consumption in particular, slow, to get GDP growth closer to 2%. If that were to happen, which we think is a high possibility, I would say that's our base case. If that were to happen, volatility in bonds would come down, your term premium would stabilize, your 10-year yield would probably remain around current levels, and the yield curve would continue to steepen, but mostly with the short end coming down. So think about a world from here, if we're correct, and the economy slows from the blistering pace it's at now to roughly 2%, and wages continue to trend down, of a continued steepening, but now it's driven by your expected Fed funds rate 2 years from now being closer to 3.5% or something like that. And the 2-year comes down roughly 3.5% range. You keep the current 10-year yield-ish, call 4% on twos, keep the current 10 or 3.5 on twos, keep the current 10-year yield, and you get anywhere from 100 to 150 basis points positive on the yield curve. That would be a very positive outcome for risk assets. But it does assume that wages come down without the unemployment rate having to go up aggressively.
Right. It's so funny with economics. We need wage inflation to slow down, so you can't make as much money for the economy to stay booming. Otherwise, you're going to get the wrong shape on the yield curve. Not the wrong shape. You're going to get the right shape for the wrong reason.
Yes.
So yeah, we're still going to have that kind of normalizing of the yield curve, but it's going to be because the long rates went up so high as opposed to the short rates coming down, which is the desired effect for.
And a really important nuance there is, and everybody here, please, if there's one thing to take away, keep this in the current context, just write this down. Above or below trend is what matters. So the Fed thinks, and most economists think, that the economy can only grow 2%. So if you're well above 2%, the Fed's going to be biased to tighten, and interest rates are biased to be higher, which is, we just printed 4.9%. Like that's why interest rates went up a lot. And as long as that's the case, the Fed is biased to tighten. So if we don't slow in 4Q, there is a material risk that the Fed has to tighten a lot more. 10-year yields have to go up a lot. And our call would be wrong, but because the economy is so far above trend. So it's really critical that you get the economy back to a trend pace.
Got it. We do have a question here on rates while we're talking about rates. Comparing this to the 80s, and one of the things that happened in the 80s was the flash crash of 87.
Yep.
Do you see any similarities between what's happening now and what was happening then that could increase kind of like these, instability risks, I guess?
I see that. I mean, I don't want to, it would be foolish of me to say that there'd be like another 87.
Yeah.
It's kind of like a black swan to a certain extent. But I am very sympathetic to the idea that in a persistently higher inflationary backdrop, or let me rephrase that, inflationary pressure backdrop, that you will have much higher economic volatility and by extension, market volatility. And so the 80s, and I would say into the early 90s, are very consistent with today's period to a certain extent, because it looks like the Fed is going to be willing to let inflation run at above 2% on core, like they did in the 80s and 90s. They won't let it get, they don't want it above 3 because that, risks unmooring inflation expectations. You have a lot of shortages in housing. You have a lot of shortages in structures. You have Inflation Reduction Act, which is an impulse. All that means is you will have consistent upside inflation pressure, which will lead to more economic volatility as interest rates have to keep adjusting to keep the economy in check.
Got it.
And I'm making it, and that's how you end up with market events. Again, I don't want to say 87, but that's how you end up with market events along the way, because the adjustments are not as smooth as I just made them sound.
Right. Yeah.
But non-recession, a lot of economic volatility, not necessarily recessionary.
Right. So moving on again to our last topic, and I think that I've already had you talk longer than we planned on the first two topics, but we're gonna still try to get to this last topic here, because I think it's important, which is geopolitical events and how they affect what happens here in the U.S. and what happens around the globe in markets. And as we all know, we have the most recent event in Israel with the Gaza conflict. We've had Russia-Ukraine going on for quite some time now. And we always seem to have a underlying tension with China. It's probably one of the reasons why you guys have a China specialist, like someone that's really just dedicated to China on staff there, and he does great work. But can you maybe touch on, you don't have to touch on any one thing in particular, but kind of how these underlying geopolitical events can come back and affect our economy, and what further shocks might really, I mean, it's always hard to say what's going, what could happen, but how could these really turbocharge their effect on the local economy here?
Yeah, so the one thing to keep in mind before I get into this is that the U.S. economy is a very closed economy.
Yeah.
Right, we're a consumer-driven, closed economy. We're not as dependent on the rest of the world demand. We're much better exporting shocks than we are importing them, particularly through the U.S. dollar. So just that in mind. So the bar is a lot higher than people realize for geopolitical to have a significant impact on the U.S. economy. It can have a bigger impact on markets, given foreign sales or larger drivers, some of the multinational names. So when I think about geopolitical shocks, to put it very simply, you have to think about things that are going to lead to, say, an outlier increase in oil prices, or a significant deterioration of the flow of goods and services. Right. So think like supply chains for shutting down for different reasons in a China-Taiwan conflict versus, say, COVID. And for now, the geopolitical overhang related to Ukraine and what's going on in the Middle East is not as much of an issue as people may think. It could become a lot larger if Iran gets more directly involved. When I say involved, if we actually start a war with Iran,
right,
then you have a material oil risk. But if it stays relatively confined to the current area, then the impact on risk assets would not be significant. It's a long way of saying, if inflation came down in a benign manner and the Fed's like, all right, we're done, and financial conditions eased, I would be long the market right now, despite what's going on there, unless there was more of a direct conflict with Iran. As far as China-Taiwan is concerned, I guess the one real worry is, but there's really no way to hedge against this now? And Jan, I don't want to sound trite or this is the wrong word, like, unsympathetic, but lightening up on Apple ahead of a potential China-Taiwan conflict's not going to help you, right? We're talking about an event that's going to be potentially catastrophic.
Right.
So
yeah, the comparison between Russia invading Ukraine is not anywhere near
exactly
the same as China invading Taiwan or a
yes.
conflict.
Yeah. So it's like you should have hedges in your portfolio against something, which would be like your tail risk hedging. But like, like reducing my position in Apple from 1.2 to 1% is not like going to be beneficial ahead of that. I guess the one worry is the going assumption of Michael Herson, our analyst, who's so everybody knows he was U.S. Treasury's representative in Beijing, so dealt directly with the Chinese government. He's very well informed. Is nothing. It doesn't not a given that anything will happen, but likely 8 to 10 years away before something would happen, and that's the kind of need for the Chinese military apparatus to get ready for such an invasion. Because remember, annihilating Taiwan doesn't do anybody any good. Right. I mean, they want to absorb it, kind of like Hong Kong. So you have to be able to do that. I guess the one risk is, given what's going on now, maybe that's pulled forward in some way, shape, or form. But I think that's difficult to, again, to position for or even think about, because we don't really know.
Right.
Broader geopolitical risk, more worried about China's assumed to be a melting ice cube as far as economic growth is concerned. I mean, if you had a real sharp slowing in economic growth, given that they're unwilling to support the property market, given that consumer savings rates are really relatively high, it starts to look a lot more like Japan, more unrest. That would probably be an issue that would affect equity prices here in the U.S. So a little bit worried about downside economic risk in China, given that they're unwilling, they seemingly unwilling to support property and do big bang infrastructure stimulus.
Yeah, I think one of the things I've read from Michael is he's constantly keeping an eye on, really obscure government meetings that I have never heard of before. But he's really looking for, it seems to me that he's looking for indications that the government of China is going to take a more active approach in propping up that economy, the property sector, and other parts with stimulus. And he, I guess, to your point and to what I've read from him, he's not seeing any indication that they're looking to do that right now.
Yeah, and everybody agrees that the consumer is what needs to be supported now. So if you're not going to support the property area and you don't want to do the type of fixed asset investment that you did coming out of previous slowdowns, right? So not to be cute, but like, building empty, cities that, end up being empty or whatever.
Those cities, right?
Yeah. So you need to support the consumer. And there seems to be unwillingness of the Chinese government to support the consumer because they view it as wasted. They have less control over it too. So they're much more willing to invest in, supporting battery factory and exports and manufacturing, and exports, than they are giving money to consumers, which is what is needed now. So one thing I would say then, the release valve is the yuan, right? So you should probably expect a pretty steady decline in the Chinese yuan going forward, because they will be more dependent on exports holding up to support the economy, which theoretically lowers the risk of Taiwan invasion.
Well, given the fact that you just mentioned that Chinese savings rates are higher. Would propping up the consumer be something meaningful that the Chinese government could do?
They could. They have the ability to. They don't seem willing, and that's the problem.
Okay.
Because they view it. They would rather support things that they control.
Yeah. Well, one of the last things that I'll talk about on China here is, you mentioned that nobody, especially China, but the rest of the world too, no one benefits from destroying Taiwan. And the main reason is, other than the catastrophic loss of life, but just to talk about the economy here, Taiwan Semiconductor, probably the most sophisticated chip builder in the world, is located on Taiwan. And so I think that would probably be one of the, given what the US government did to China in terms of decreasing the access to China of the chips that are produced right there in Taiwan, many of them, that obviously would be a goal of any kind of military
Sure.
event. So I expected to see China to do some sort of retaliation to the US for that move to limit their semiconductor access, for AI defense and all these other sophisticated, semiconductors that are needed for today's world. They just started by putting a limitation on lithium. Do you see other potential actions that the Chinese government can take that would actually impact the US in a negative way?
Yes, it's possible. Not going to happen ahead of the potential Xi Jinping Biden meeting.
Right.
Right. So I think we have to see how that plays out. There, as far as we're understanding, seems to be some back channeling now to be a little bit less tit for tat. Put it in those terms. But if there's not confidence on both sides that there's some understanding, then we would absolutely see an unfortunate kind of continued negative feedback loop.
Right. Dennis, I want to thank you so much for being here. I want to give the audience an opportunity to ask some questions if you have any. But one of the questions that one of the last questions that I have for you, and I think it's a really interesting one, and it's kind of not on the topics that we've talked about. But I would love to know, there's been a real disconnect between small cap and large cap stocks
Yes.
for a long time. And, you can look at the, just like things like the S&P 500 or other large indexes, and they're dominated by the mega caps. What can happen to change that? What can happen to change that story? I mean, you just have this small selection of companies really driving the, market performance in an outsized way. What can make that flow down to, mid and small caps in a more, beneficial way for investors that are kind of looking for unique ways to get alpha from, stock picking?
Well, good question. It's a major area of debate right now. To start, I think if you've got a 3-year plus horizon, own small caps now, certainly on a relative basis. I'll come into why. Mega caps have significantly outperformed. The cap weighted index is 2 standard deviations outperformance versus the equally weighted index. I should start by saying the companies are awesome, technical term. So I don't want to, it's not like people are just totally crazy. These are great companies. But I think the main reason why you're seeing the significant underperformance, and you have, is the inability to price the cycle. So I talked about this before. The most positive thing would be GDP growth going from 4.9% down to 2%, because you would be at trend. And if you're at trend GDP growth, then recession odds on a longer term basis are lower. So near-term recession risk is very low because the economy is strong, but you still have the risk of the Fed making a mistake because inflation's too high, right? And that's interest rates going up very quickly, et cetera. So I made this point earlier that longer-term recession risk is still elevated. And every time interest rates go up, your longer-term recession risk goes up beyond 12-month horizon. So as long as we have inflation that's high and we have the economy that's running significantly above trend, counterintuitively, you would think if the economy is very strong, small caps, more domestically oriented, should doing fantastic. You're seeing nothing but multiple contraction because investors can't price the cycle. I can't say that these companies are going to earn X over a 4 or 5 year period. I get it. The next 2 quarters could be great because the economy's strong, but can I really discount a 3 to 5 year cycle? That gives me confidence that these can outperform those large caps. And the way you get it is basically the economy running roughly at a 1.8 to 2% level. From May to late July, if you recall, soft landing was the story, right? And it was roughly 2% economic growth. And what did we see? We saw the average stock outperform, and we saw a rip in small caps.
Yep.
In August, the economy started to take off, rates went up, and what happened? Oh God, the Fed's gonna have to tighten again, we can't price the cycle, et cetera. So the way you get there is, like I said, is having confidence that we can price the cycle, which will happen if GDP growth's at trend, wages come down, and we can all be confident that core inflation is going to come down towards 2.5% without the unemployment rate going up. That's the combination of events. And that's and by the way, given the underperformance of small caps, which is as historic as we've seen over any time period, own them over 3-year period. The timing's just difficult right now.
Couple other questions that just came in. One, I don't know if this is your area of expertise, but there's been a lot of talk of AI.
Yep.
Do you have a sense for how to invest in AI other than buying NVIDIA?
My sense for AI actually dovetails where I just was. I think the main beneficiary of AI will be if you really believe that it's a general purpose, game-changing technology, which I think there's a strong case to be made for that. And it's going to play out over 5 to 10 year period. It's already impacting our business in a profitable way as far as our need to hire certain people. We get a lot more output, right, relative to labor costs. I would say that the average service company will have higher profitability because of AI, which goes back to it will probably NVIDIA will win, obviously, but so will the average company.
Well, I'm wondering, also some of the things that Microsoft and Google and Facebook have been doing so much with AI as well. I'm wondering how much they're benefiting from AI versus their core businesses. But I think this is like early days of the internet, where we're going to have winners and losers that are going to come out of this, and anything associated with AI might start, kind of take off a little bit. But there's going to be some pets.com AI type strategies out there, where they
Related to AI, I just had a discussion with this. I will be forthcoming report. Never short U.S. innovation. So, I think AI is going to be a general purpose, and it's going to be very profitable for the broad set of companies. Krispy Kreme donuts just got downgraded today because of Ozempic.
Because of Ozempic?
Yes.
You're kidding.
Yes. Because and you think about this Ozempic craze, it's probably overdone, but there is a case to be made that broad healthcare costs could come down some based on this, right? And when you start thinking about it, if obesity gets, for lack of a better term, more under control, I'm assuming best outcomes. I get it. So people that are healthcare investors, might debate this, but when you think about the combination of something like Ozempic, which really is a killer drug in a positive way, meaning it's almost like a Crestor in a sense, and it's available to the entire world. And you think about AI, you could make a case for U.S. innovation keeping profitability and real incomes elevated for a very long period of time. Just something that people should. It doesn't mean the stock market's going up aggressively. It's just something to keep in the back of your mind.
So something that's against recessionary risks, for sure.
It's bad for Krispy Kreme, I guess. I don't know anything about it. I don't follow companies, but but it's an interesting discussion.
Krispy Kremes are pretty good. If I'm gonna have, I know Ozempic just makes you want to eat less, but if I'm gonna eat something, I might as well be a Krispy
I know.
All right, and last question for you. Where would you buy now on the short on the curve? I know you talked about this a little bit, but so which case, I guess, that you made, do you think is going to come? Do you think we're more likely to have a lowering of the short end, or do you think that the long end is likely to?
In our base case, I would say it would be the short end of the curve. So I'd be more favorable towards two. I think 2-year yields are pretty much, and your skew there is really favorable in the sense that the economy is probably slowing either way, either the hard way or the easy way. Our call is the easy way, but if we're wrong and it's the hard way, twos are coming down. You could be a 1%. So your skew is pretty attractive.
And even if you don't get the move in the twos, I would say that the rate that you're getting is pretty attractive at that point too. For the
exactly. Yes.
All right, great. Dennis, thank you so much for spending a little extra time with us today. It was great to have you. Again, if you guys are anyone out there, 22V Research, please check them out. They are a phenomenal company, as you just heard from Dennis. A lot of information. Thank you, Dennis. We'll talk to you next time.
All right. Thanks so much. Have a great one.